You've heard a lot about inflation over the past few years. Groceries cost more, rent costs more, everything costs more. But inflation isn't just a current event story. It's a permanent feature of the financial landscape that quietly erodes your wealth every single year. Understanding how inflation works, and more importantly, how it affects different types of savings and investments differently, is one of the most useful things you can know as a Canadian investor. Let's break it down. Inflation is the rate at which prices rise over time, which is the same as saying it's the rate at which your money loses purchasing power. Canada's inflation target is 2% per year, set by the Bank of Canada. In a normal year, $100 today buys roughly $98 worth of stuff next year. Over 10 years, at 2% inflation, $100 only buys what $82 would buy today. Over 30 years, it's worth about $55 in today's purchasing power. That's money sitting still. The problem isn't just rising prices, it's that any money not growing faster than inflation is slowly shrinking in real terms, even if the number on your statement looks the same. This is where it gets important for Canadian savers and investors. Cash in a checking account earns essentially zero interest. If inflation is 2%, that cash is losing 2% of its purchasing power every year. Keeping large amounts of money in a checking account long-term is a slow, guaranteed loss. High-interest savings accounts and GICs help, but only partially. As mentioned in a previous video, GICs currently pay around 4 to 5%. If inflation is also running at 3 to 4%, your real return, the return after inflation, is only 0.5 to 1%. Better than nothing, but not wealth-building territory. Stocks and equity ETFs are historically the best hedge against inflation over the long run. When prices rise, company revenues and profits tend to rise with them, meaning the underlying value of what you own in a diversified ETF grows alongside the economy. Over long periods, equities have returned 7 to 9% annually in nominal terms, well above the historical inflation rate of 2 to 3%, leaving a real return of 4 to 6% per year. Real estate also tends to track inflation over long periods, which is one reason why home ownership has historically been a reasonable store of wealth, though, as mentioned in a previous video, the net returns after costs are more modest than they appear. Bonds and fixed income are more nuanced. Rising inflation is generally bad for bonds because the fixed payments they offer become worth less in real terms. This is why rising inflation periods, like 2021 to 2023 in Canada, tend to hurt balanced portfolios more than pure equity portfolios. The practical takeaways from all of this are straightforward. Don't hold more cash than you need. Your emergency fund in a high-interest savings account is appropriate. It needs to be liquid and accessible. Beyond that, cash sitting idle is a guaranteed inflation loss. Get it invested. For long-term money, equities are your inflation protection. A diversified equity ETF like XEQT or VEQT, held inside a TFSA, grows in real terms over long periods and generates tax-free returns. This is the single most powerful thing most Canadians can do to protect their long-term purchasing power. Don't overreact to short-term inflation spikes. When inflation spiked in 2022, many investors panicked and moved to cash or GICs, and then missed the equity market recovery. The Bank of Canada's inflation targeting means inflation returns to around 2% over time. Staying invested in a diversified portfolio through inflationary periods is almost always the right move for long-term investors. For near retirees or retirees drawing down savings, inflation is a more serious consideration. A 2% inflation rate over a 30-year retirement meaningfully reduces purchasing power, which is why maintaining some equity exposure even in retirement, rather than moving entirely to fixed income, is generally advisable. The bottom line? Inflation is always working against money that isn't growing. The best protection for most Canadians is simple. Stay invested in a low-cost, diversified equity ETF inside a TFSA. Don't hold excess cash, and think in real returns rather than nominal ones. You can't control inflation, but you can make sure your money is positioned to outpace it over time. Next week, we're covering something a lot of Canadians eventually face: how to find a financial advisor, what to look for, what questions to ask, and the fee structures that can quietly cost you tens of thousands of dollars over a lifetime. Subscribe, and I'll see you there. See you then.